When you retire, you could use your retirement savings to buy an annuity or use Flexi-Access Drawdown. I want to look at 5 reasons why you might consider drawdown over an annuity, but let me explain what a Flexi-Access Drawdown is. It involves you being able to take 25% of your pension tax-free, but then leave the remaining 75% to grow tax-free until you're ready to withdraw it. Flexi-Access Drawdown is available from age 55 or 57 from 2028. Flexi-Access Drawdown is the only way to take your tax-free lump sum on its own without taking any additional taxable income, and is worth considering if you need to withdraw some cash. Flexi-Access Drawdown enables you to withdraw as much income as you like whenever you like, though of course all withdrawals after you've had your tax-free cash will be taxed as income. If you decide later on that you want a guaranteed income for the rest of your life, you can use some or all of your remaining drawdown funds to buy an annuity. Annuities aren't as flexible, but they do offer a guaranteed income for life. You might like this if you don't want the hassle or worry or concern of managing investments and you're looking for what is close as it gets to a risk-free income. Annuity rates have been quite low in recent years but are starting to become more attractive as interest rates continue to rise. I can't guarantee that that will continue, and annuities may become even less attractive in future if only a small amount of retirees buy them, especially if those retirees end up living a long time. I like annuities. The way they work is like lots of retirees pooling their money together, and those that live longer than average are subsidised by those who live shorter than average. And remember, if you have poor health, you may get an enhanced annuity rate. Now, let's take a look at the 5 reasons you might want to go for Flexi-Access Drawdown over buying a guaranteed annuity. So, benefit 1. Take the tax-free cash and you could keep working and contributing, of course. When you reach age 55 or 57, if you won't get there before 2028, when the rules change, you may want to get your 25% tax-free lump sum and keep working. Any additional income you take from your pension pot in any form whilst you're still working, including annuity income, could be taxed at 40% or more, as it will be added to your other income to work out what tax rate you will pay. One huge benefit, of course, of Flexi-Access Drawdown, as I mentioned at the start of the video, is that there's no requirement to withdraw income from a Flexi-Access Drawdown arrangement. Once you've taken your tax-free cash, you can postpone withdrawing income until you actually retire. And your income tax, of course, the rate that you pay income tax may fall because you've got less income. This means that your pension savings will continue to grow tax-free whilst you're still working. Benefit number 2. Keep your favourite investments, of course. If you choose to buy an annuity, you'll have to sell your pension investments and pass your savings to an insurance company to buy the annuity. Now, if you're confident your pension investments will perform well, this may not be an attractive option for you. With a drawdown pension, you can enjoy the best of both worlds if you choose. You could choose an income plus tax-free investment growth on the money left inside your pension. Benefit number 3, wait for better annuity rates. Now, of course, you may want to ultimately use your pension savings to buy an annuity because the income is more secure than relying on a variable drawdown income. And that's because your annuity income never falls no matter how long you live and no matter what happens to interest rates and the value of investments. You've obviously got to be concerned with what inflation is doing. Now, the issue is that annuity rates may be low when you retire if interest rates are low, as they have been recently. You could start your retirement with a Flexi-Access Drawdown pension and make a phased exit by using part of your drawdown money to buy an annuity at regular intervals if interest rates rise and annuities become more attractive. Of course, they will become more attractive as you get older because your life expectancy is less. Benefit 4. Vary your income and save tax. Now, varying your income from year to year as you can with Flexi-Access Drawdown allows you to do a lot of tax planning to make your income as tax efficient as possible. This is really helpful in years when your tax bill may rise sharply because you've received a big one-off receipt such as a capital gain. Let's say you sell a buy-to-let property and the capital gain is $50,000. If you reduce your drawdown income in the same tax year so that your basic rate band is not fully used, you will only pay 18% tax instead of 28% tax on a big chunk of your capital gain. The basic rate band is currently $37,700, so the maximum potential tax saving from paying 18% capital gains instead of 28% can be calculated by multiplying $37,700 by 10%, giving you a tax saving of £3,770. If you've got a portfolio of rental properties and you want to wind down your portfolio gradually when you retire, drawdown allows you to do just that. If you plan well ahead, you could benefit from this kind of tax saving every time you sell a rental property. You could make additional capital gains tax savings by spreading property sales across several tax years, because of course that would allow you to make use of more than one annual capital gains tax exemption, i.e. your yearly exemption. Benefit number 5, leave some money for your family. If you're receiving income from a bog standard annuity, it will cease when you die. You may have bought a joint life annuity with your spouse. And of course then if you die, the income payments will continue to your spouse, or maybe just 50% will do, depending on the type of annuity. Income will be continue to be paid if you've paid the level of a guaranteed period, of course. What your beneficiaries won't get, however, is any kind of lump sum payment or of a remaining pension pot, which is possible with flexible drawdown. The tax treatment of annuity income payments after your death has become a bit more generous since the 6th of April 2015. If you die before age 75, payments made to your beneficiary will be tax-free. If you die when you're 75 or older, any income paid to your beneficiary will be taxed at their marginal rate. Thank you for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help you have a successful life. That, in my experience, often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to check that out. I'll put a link in the description below. And of course, you can sign up for my weekly newsletter, which is packed with inspiration and tips for a successful retirement. I hope you've enjoyed this video. If you have, please press the like button, help more people like you find my channel. And of course, subscribe so you never miss a video. For now, I'm Justin King, helping you live your best life.